The Relative Value Index is an oscillator that evaluates the strength behind the price move. It attempts to provide a guide to the techniques of the market to persist in the same directions of the move, or for the piece of the move to break down. The Relative Vigor Index is based on the principle that is the rise in market we expect to closing price to be the balance and in general higher than the opening price. Similarly, in the following market we expect the closing price to be more often than not lower than the opening price. In other words, at this course, this indicator tries to measure whatever the market is bullish or bearish. It does this by making the comparison between the instrumental closing price and its opening. The RVI formulas its look at the difference between the closing price and the opening price and the normalization it to the trading range other the period. Then the values of the RVI are leveled by the additional simple moving average. In fact, the calculations method or the relative vigor indicators is very similar to that used for the stochastic oscillator. Another popular indicator, the relative value index, tries to anticipate the changes it markets trends. Since the relative value index is an oscillator, it bonused above the below zero, producing both positive and negative values. So, what the settings of these indicators? The relative value indicators is made of the two lines. The green lines is the strange moving average of the RVI indicator. The dreadful value is the green line is the 10 periods, but you can change it into multiple ways to suit your needs. Most of the traders change the dreadful value some of the common to 7 and 14 or 21 periods. The higher the number of the periods you choose, there's the less chance of the false signals. But the downside of the using higher periods is that you get less amount of the traders in the market and possible late entries. The red line is the trigger line and it is the 4-period volume weight moving average, and it provides the trade signals when it crosses above the or below the green line. The time frame for your chart when your RVI is important choice. These indicators was originally diversified like so many other popular trading indicators to be used in conjunctions with the end of the day price data, but there is no reason that the indicators cannot be used for other time frames also for the day trading or even scalping. How to read the relative value indicators? The key factor to the relative value indicators is what price tends to choose higher than the opening price in the upward trend and closer lower than the opening price in the downtrend. Higher value is the RVI point out to increase the strength to tend while lower value indicators weakening of the strength. Generally, the higher the indicator climbs, the stronger the current relative price increase. The lower the indicator falls, the stronger is the current relative price drop. Together with the trigger line, the red 4-period moving average, the indicator may help to identify changes is previewing price developments. Crossing the signals line from the above the RVI signals a possible sell opportunity. Crossing the signals line from the below the RVI signals a possible buy opportunity. Notice this example is how the green RVI lines cross under the red signals line, continuing with the bearish strange in the price. Also notice how the upwards crossing signals periods where the market becomes there bullish or stops being bearish the oscillator naturally moves in the wave pattern. We can attempt to add the rule restricts trades to move the favorable conditions and to limit to the part of the false signals. This would mean only acting on the crossover signals to buy if the RVI is above the zero. Similarly, we would only act on the crossover signals to sell when it's below zero. From my experience with this indicator, the crossover signals are not quite reliable. Now, let's talk about the danger of using RVI searching for the overbought or oversold signals. Overbought and oversold topic is one of the biggest problems and falls into the trading. The RVI indicates does not shows oversold or overbought prices. It shows momentum. Generally, traders would buy then the high RVI value means that the price is overbought, and when the RVI is below the certain number, the price is considered oversold. And what traders then mean is what the oversold market has the high chance of going up and vice versa. This is the wrong and very dangerous as we see in this example. When the RVI research extremes levels, it means that the trend is the strong and not that is the overbought and likely oversold. A high RVI means that the price is above the cross near the top and it keeps pushing higher. The trend when the RVI stays high or the long time signals the momentum is high and not that you should get ready to short one market. This chart shows the behavior of the RVI within the long uptrend and the downtrend. In both cases, the indicator entered overbought and oversold areas and stayed there for quite some time while the trends keep up going again, and believe that the RVI shows the oversold overbought is wrong and you will quickly run into the problems. If anyone you trade this way, that's why the better methods of using the RVI is by paying attention in the zero level. You ignore overbought and oversold signals and concentrate on the crossbought around its main line. Crossing it from the below signals buying momentum, while the crossing it from the above signals to sell momentum. This signals is also not very reliable on its own, but alongside additional instrument like other indicators of the price actions patterns, it's often better to signals the overbought and oversold ones. I like to combine RVI with the pivot points. Pivot points represent levels that are used by floor traders to determine the directions movement and potential support resistance level. They become popular once traders on the floor exclusive began to use them. Pivot points are the accurate indicators because most market practice the watching and the trading these key levels. The big advantage is that the fact they are based on the purely and the price. I like to add the concentrate pivot points and to trade price rejection. Here's how I would trade with the RVI and the central pivot point. The price is above the pivot point. I consider to outlook of the being bullish. If it is price is below the pivot point, the outlook of bearish. When the RVI is above zero, we have indicates buying power point, and when the RVI is below zero, we have to sell in momentum. So the rules are simple. We want the price to be traded above the central pivot point, the RVI above the zero, and we want to see rejection of the pivot point level. This means that the price must touch in the pivot, but it's able to go through for the short opportunity. We want the price trade below the central point, RVI below zero, and of course we want the rejections of the central pivot point. Here's the few examples to understand better how to take signals using the RVI and the central pivot point. Another powerful signals offered by the RVI is the divergence because the RVI accepting the higher closes is to uptrend and lower closing is the downtrend. The divergence can signal early change in the directions of the trend. If you watched other videos on my channel, you probably know that I'm a big fan of the divergence as they can be powerful lending signals. In this example, you can see that the RVI directions at work first. In the downtrend, you can see how the price passed fresh. But the RVI has the signaled a higher low in these cases, anticipating a change of the direction in price. This is lower followed by the gradual move in the price to the upside. Here's notice a hidden bullish divergence, which signals that the price will continue to the upside, following the break to the resistance level seen by this horizontal line. The price then established the uptrend. The same setup for the bearish divergence. A bearish divergence appears here during the uptrend when the price is making higher heights, but the RVI indicators indicates lower heights. That's strong indicators of the mix exclusive and the possible sign of the market reserve or at least the short-term corrections. Regarding its limits, the Relative Vigor Index indicates usually responds to the market change slightly later than the actual moves takes place, and if you are higher privates, then it takes even more time to offer a signal. The major problems with the RVI is it generates false signals in the range bound markets, so make sure you don't really exclusive on the RVI and its confirmation rather than the main signals for your setup. As always, if you find valuable and learn something new, we also like to show your support. Subscribe to our channel and click the bell icon to stay notified when we release a new video. Until next time.